Hi, my name is David Small. Welcome to the Kelly and Small website. Today I'm going to talk about whether or not you should pay off a mortgage or not. I get this question quite often, and basically what it comes down to is a couple of major issues. First of all, a lot of times when people get elderly and they're coming to the end of their mortgage, they start to think, why am I paying this mortgage? Why am I doing this monthly payment every month? It cuts into my budget. It makes things a little bit tighter every month, and so why not just pay it off? But then they always come to the other question of is, well, but what about the interest deduction? What about what I get off of my taxes, and how is that helping me? And the government's done a very good job of selling people on the mortgage interest deduction, and so we have to oftentimes weigh that out. What I'm going to try to explain today is a couple of points that you can think about when making this decision, but then also remember that it's always an individual situation. So basically, when you're making this analysis, what you have to look at is you have to look at what you're earning on the mortgage you're paying. In other words, if you're paying a mortgage, and let's say you're paying a mortgage at 5%, okay, so that's costing you 5% of whatever your mortgage is. So in the same terms, if you didn't pay that mortgage, what you would have is a 5% earnings on those dollars. So it can be kind of an analysis that you could look at as like we're in a bank, you would be earning 5%. Now the other thing that we have to consider in this is, again, there is the deduction for the interest on the tax return. So that it always ends up being an individual situation. For example, there could be some people that have the mortgage interest that they're paying, but they're taking a standard deduction on their tax return. Standard deduction means they're just taking the flat rate that the government gives you anyways. So in that case, they're getting no benefit for the interest deduction. So pretty easy then, you're making 5% on that money if you pay it off. However, more complicated situations, somebody's itemizing, they've got a mortgage, and so then there can be an advantage by paying it off. One thing that I always look at in that, again, just a ballpark, is that let's say your mortgage interest is at 5%. You're getting a tax deduction. That tax deduction would vary for everybody. But let's just say, as a way of an example, that's going to knock off 0.5%. In other words, you're going to get 0.5% of your money back by getting the tax deduction. So in that case, you're not really earning 5% if you pay off the mortgage. You're earning about 4.5% because you're getting a tax deduction by recording it on your tax return. So now what we do is so let's assume those numbers, and we're at a 4.5% return if you pay off the mortgage. Now we've got to look at and say, where's that money going to come from? If that money's coming from a CD that's earning 2%, that's pretty easy. Take money that's earning 2% and pay off a loan that's costing you 4.5%. Pretty easy scenario. Let's swap those out. Let's earn the 4.5% instead of the 2%. It could be a little closer. Maybe you're earning 4% and 4.5% here. Then you've got a little bit tougher decision. Or perhaps you're earning 6 or even 8% in some very volatile type or more risky investments that are paying you a bigger return, and you're up at 6%, and this money here is at 4.5% that you're paying on your loan. Well, then you really wouldn't want to pay off the loan. You'd be better off taking the tax deduction, keeping the money on the loan, and keeping your other money working for you. So like I was saying, if you're at 6% in your earnings on an investment account and 4.5% on your mortgage interest, it's a pretty easy decision that you'd want to pay off, or that you would not want to pay off that mortgage because you're earning more with the money than you would be saving by paying it down. One other thing to consider, as I was mentioning a minute ago, again, if you're at 2%, say you've got your money in a CD and your mortgage is at 4.5%, then that would be a little bit, more of a decision, more geared towards paying off the mortgage. But one thing that I always want to caution in this case too is you don't want to leave yourself cash poor. And basically what that means is that if your mortgage, let's say your mortgage is $100,000 and you've got $120,000 in the bank that's earning 2%, and your mortgage is 4.5%. So logic would say, well, pay that mortgage off, but that leaves you with 20 grand in the bank. It'll be much more expensive to refinance and pull money out if you get in trouble and you need cash. So I wouldn't recommend it in that case. So you don't want it to affect your cash flow. If you have $1 million in the bank, your mortgage is 100 and you're in the 2% and the 4.5%, let's just say, then it's an easy decision, pay off the mortgage. But you don't want that to be, to inflict upon your cash flow or your cash needs. You want to leave something in reserve instead of taking everything out of your bank account. So anyways, that's it kind of in the nutshell. I hope this has helped. And what I recommend in all these circumstances is we've got to look at your own individual situation. So what I would say is make an appointment, come on in, we can look at your particular circumstances, we can figure out how it's going to benefit you, what you're actually saving from the mortgage interest deduction, and we can put some numbers with the theory and really get you some real good information to make your decision. So thanks for listening.